Hi everyone, welcome to Captive Review's Virtual Symposium. We're going to start in a few minutes. We're just going to wait a moment so we can make sure that everyone has logged on. All right, good morning or good afternoon everyone, depending on where you are, and welcome to the first of Captive Review's Virtual Symposiums. We're running a series of these, and the first of these is in partnership with Seeker for today's symposium, which is going to be on hot topics of the captive world. So first, just a little bit of housekeeping. As all our virtual symposiums are interactive, we're going to be using Slido so that everyone can vote in polls and put in some questions for our Q&A. So if you go to the website slido.com and enter Captive Virtual, you'll be able to vote in a poll for the topics that our lovely panelists will be speaking on and enter your questions for them. So make sure you go there, it's just on the website slido.com. Just to quickly go through our agenda for today, we're going to have a quick welcome from myself and my fantastic co-host, who I'm sure you all know, the president of Seeker, Dan Toll. Then our panelists are going to talk a little bit on some of the hot topics for today. During this time, you'll be voting on the topics that they're going to be speaking about in the second part of our session. And then we're going to chat about the 3 highest voted subjects. So we're going to close out with some Q&A, so make sure you're submitting all your questions at slido.com. So now I'm very pleased to introduce Dan Toll, who's going to speak briefly to you all. So hi, Dan.
Thank you, Lauren, and I'm glad to be here and be partnered with Captive Review on today's virtual symposium. We're thrilled to have such a large group on the webinar, and I hope everyone listening is healthy, safely at home, and doing all you can to stop the spread of COVID-19 by following the recommended guidelines. As Lauren said, my name is Dan Toll, and I'm the president of Seeker. For people who do not know what Seeker is, Seeker stands for the Captive Insurance Companies Association. We are the premier domicile neutral trade association for our industry. Most of you likely know that we recently had to cancel our annual conference due to COVID-19. In fact, the Seeker conference has the dubious distinction of being the first insurance conference to be canceled because of the coronavirus. Many of you know that the annual Seeker conference is the culmination of efforts from many volunteers throughout the year, and also is a celebration of best practices for our industry, providing great education sessions and networking opportunity. While it was difficult to have to cancel the conference, the good news is that Seeker is proud to announce that most of the great educational sessions that you would have heard at our annual conference will now be available through on-demand webinars. We hope to have more than 20 sessions available for you once we are done recording them. So please be on the lookout for details coming in the next few weeks on how to register for these, as they will be a perfect way for you to access relevant and up-to-date captive education. Now moving on to today's hot topics. I believe we will be in for an excellent session, and we have a great group of expert panelists. Our industry never lacks its challenges, and there are many issues facing our industry to be discussed today, from effects of the hard insurance market, to new threats facing small captives, to tax consequences of new laws, to the challenge of renewals, and other issues which you will get to vote on. We have much to talk about. And yes, at the same time, our global community is dealing with a health crisis. As individuals, the coronavirus has us concerned about our health, our families, and our preparedness to help reduce opportunities for exposure. And we are all likely working at home with all the challenges that may bring for many of us. However, as insurance professionals, The effects of the coronavirus are going to test us in many ways. We know the damage it is doing to our economy, and it is also affecting global trade, commerce, tourism, and supply chains. Our clients are going to lean on us in ways they have not done before as they are trying to find economic and insurance solutions during this challenging time. Captive insurance has always played an important role in filling coverage gaps in the commercial market. Now with the coronavirus, captive insurance may play a critical role in financing the new risks that are emerging in this global crisis. I believe our industry is ready for this challenge, and it will give us another opportunity to demonstrate the true risk management value of captives. While this may be a stressful time, this should also be an exciting time for our industries. Companies that have captives will be able to give their owners flexibility and options that will not be readily available in the traditional market. Companies without captives will be looking to form them. In both cases, captives will have an opportunity to shine, providing value to their owners and elevating their benefits to their organizations. This will be an exciting time for the captive insurance industry. I look forward to being part of today's educational session. And with that, Lauren, please continue.
Thanks so much, Dan. So now I'm going to introduce our panel. So we have a lovely panel of experts today. As many of you may already know, we've got Dave Provost, who is the Deputy Commissioner of Captive Insurance in the state of Vermont. We have Courtney Claflin, who is Executive Director of the Captives Program at the University of California. We have Dan Kusela, Partner at Crow, and we have Chaz Lavelle, Partner at Denton, Bingham and Greenbaum. So we're going to start off. So Dave, I just wanted to start with you. So the market has continued to harden this year. What do you think the future holds because of this?
Well, I'm really not sure what the future is going to be now, because this is the first time anybody has listed me on a lovely panel, and I'm just blushing. So, it's the hard market started last year. We had a number of companies call us up and talk to us about the difficulties in placing reinsurance, in terms of the reinsurers not wanting to be very close to the ground, wanting to be further away from the first dollar risk, wanting to be to have less participation, higher rates. And so companies came to us last year with here it is, it's coming. The hard market is here for us. It'll be coming for everybody else. So reinsurance renewals were very difficult, and we had a lot of plan changes. And we've seen that continue all through since last spring, going right up through this spring. We have companies that are hearing that their entire industry is just being written off. I had a call from a paper mill that said their carrier called them up and said, we're not renewing, we're not in the paper mill insurance business anymore. So when you get a call like that from your insurance company, the first thing you do is panic. Well, you don't panic, but you start calling other people and say, what options do we have? And so we received a number of calls as regulators with what are our options. Are there existing captives out there for us? Or are there, if there isn't something out there for us that's an option, how do we get a captive started? So that started last spring. Again, it's continuing. What we see as a regulator is a lot of plan changes to increase the retention of the captive and decrease the reliance on the reinsurers, or they're finding new reinsurers. So we're seeing just a lot of changes in the panels. Some companies have fewer reinsurers to work with, so that their reinsurers are taking bigger chunks at the time they don't really want to take on bigger chunks. At the same time, we see the captive used as a lever. As we've often described, a captive, just the talk about forming a captive sometimes will help you with your renewals. And we do see that where companies are getting pre-approved plan changes to retain more, so they can go to their reinsurance renewal with at least a little bit of leverage to say, I'm able to retain more. So let's talk about pricing, and let's talk about what's the right and appropriate risk for me to retain and for you to assume from my captive. And then, whenever you have a hard market, you do see more captive formations, and we are seeing new formations continuing, which is nice. They're not coming to a screeching halt right now. I was around in 2008 when the market crashed, and for a while business just came to an absolute halt. And so in many ways it's coming to an absolute halt right now, but captive formations have not particularly slowed down from what I can see. We are still talking with companies about forming new captives, particularly in the property space again, where the market is very hard. And I expect that that's going to continue. The captive owners are people that look to the future to see what's and prepare for the future. So this is going to be one more lesson on preparation for the future. And this hard market, I don't know exactly how COVID is going to affect the hard or softening of the market, if anything. But at least it's going to have a lot of folks looking to the future to say we need to prepare for things, and that's what risk managers have done for years. So that's what I'm seeing on the captive side based on the hard market. So now I'm going to ask Chaz Lavelle to talk about the IRS, whatever that stands for. So Chaz, I'm going to turn it over to you.
Right. Thanks a lot, and congratulations to Captive Review and SECA, because this webinar is extraordinarily well timed on the captive tax front. There have been two major developments just within the last week. I'm going to talk about audits of small captives, and I think Dan Casale is going to talk about some tax provisions that came in just last week. Most of the IRS action has been in the last few years focused on small captives. There are a lot of people on this webinar who deal with large captives, and I always say you need to be alert to what's happening on these small captive audits. Number one, there is some precedent being established in the courts, and secondly, the IRS has now trained a large number of captive audit teams, and they've developed a lot of insurance specialists at all levels, the audit, appeals, and the lawyers, and they're coordinating. Now, to put kind of a little background on what the IRS has been doing in the small captives, 5 or 6 years ago, they put them on the Dirty Dozen list. Watch out, some of them are used abusively. In 2016, they made most of the small captive participants report themselves to the IRS on a Form 8886. The IRS has won 3 out of 3 small captive cases, the worst of which was last year when the court said not only were the premiums not deductible, but those same premiums were income to the insurance company because the insurance company couldn't prove they were non-taxable. Now, the industry knows that that's really bad tax policy because in a business-to-business transaction, you don't tax the same income twice. But lots of things have happened more recently. About 7 months ago, in September of 2019, the IRS announced that it had a settlement program at the exam level. It was going to issue that to up to 200 taxpayers. That settlement program was not extended to anyone who had a case in court, and the IRS had previously announced that it had about 500 cases in court. Now, that doesn't mean 500 captives, because if you have a pass-through insured, then each owner has its own case, but there were a lot in court. And then just within the last couple of months, on January 30th, the IRS announced that 80% of the people had taken the settlement offer that had been issued in September. And more importantly, they were going to put 12 new audit teams out to audit the small captives, and there would be thousands of audits. Then fast forward a few weeks ago, the IRS lawyers sent letters to a number of the taxpayers who were in court and says, we'll extend the September settlement program to you if you want. And then a week ago Friday, so most people got this letter last week, the IRS sent a letter, and what appears to be to everybody that had filed an 8886. So that's, in my words, probably at least 10,000 people. and they said, look, the 2019 returns are coming up. Recognize that we have won 3 out of 3 cases. Maybe you ought to talk to your tax advisors and see if you really ought to be taking a deduction. And then they asked people to, under penalties of perjury, to say, what was the last year you took a deduction or got a tax benefit? And what was the last year you were in the program? And they invited people who had taken the deduction in prior years to file amended returns, mark on the top of them, micro captive, and send them to a very specific place. And I think clearly this was the first step in implementing what the IRS had said on January 30th, that they were going to conduct thousands of audits. Those responses are due May 4th. SIA has written a letter to the Treasurer and the IRS really questioning the timing of the IRS's letter. We're in the middle of the worst pandemic in literally over a century. The federal government has shut down economic commerce throughout most of the nation. Through April 30th, the IRS itself had delayed when returns and payments were due until July 15th. And so SIA said, is this really the time to send thousands and thousands of letters out to people asking them to make important decisions by May 4th? So that's what's happening on the IRS front. Courtney, you're a captive owner. What are your hot topics today?
Yeah, thank you. And hello to everybody, and I hope this finds everybody safe and sound at home and doing well. From a captive owner's perspective, what is on my radar right now I've kind of got macro issues, excuse me, and I've got micro issues. And one of the things, as we all would know, is what can your captive do to support your owner's COVID-19 exposures and expenses. So we do have coverages from our captive back to the university system, and that can help them in that regard. Probably my biggest project right now, my hottest topic is our renewals. Our contracts renew on July 1st, all of our reinsurance contracts. And as some of you may or may not know, University of California is a pretty large system. We've got 10 universities, we've got 5 academic medical centers, and we've got 3 national labs and about 280,000 W-2s. So you can kind of get your arms around the risks emanating from our operations. We've got 14,000 physicians sitting in those hospitals. And our risk profile isn't really one that they fight over in the reinsurance marketplace in London and Bermuda. So we have to prepare ourselves for reinsurance renewals that are going to do a number of things. Number one, our terms and conditions are going to change. We're going to see more exclusions. Number two, our retentions are going to increase. So our deductibles are going to go up by millions of dollars because of the hard market. Number three, we're probably going to lose capacity. And by that, I mean as an insurance company, when my boss and my organization says we need X number of hundreds of millions of dollars of coverage in our casualty tower. Well, just imagine building a house brick by brick. The way you get to that number is that you purchase limits of insurance in buckets, and of 25 million, 50 million, 100 million, and you may have 2 or 3 reinsurers sitting in each one of those buckets or more. And what I do as a captive operation is I'll participate with those syndicates and those reinsurance companies in these bricks to fill in lack of capacity. I'll either do it with a quota share arrangement, or I'll do it with a buffer layer, or I'll do it with just taking a whole layer of risk inside the tower. So I'm juggling a lot of ways in which the captive can help the university system. But as you might imagine, these decisions usually come down to the last minute. And so in order for me to put up an extra $50 million of limit, per claim throughout a tower, you know that you've got to be speaking to your regulators. You've got to be speaking to your captive management teams. You've got to do your internal modeling to determine how much capacity can I take on and how much risk can I take. Do I have the adequate premium for the new retentions that I'm going to be getting on the renewal? Those are all the types of modeling that go into the preparation for a renewal season like this. And so that's kind of my micro hot topic is I've got to have my captive insurance platform. We've got 5 captives. I've got to have them ready and prepared to make financial decisions that have large ramifications. And they come from taking larger quota shares, putting in layers of insurance, writing direct issue policies for exclusions that are coming out of the marketplace that we need that coverage. So we've got a lot of activity going on in terms of preparing yourself for what's going to happen. And then you add to it the COVID-19. As you can imagine, with almost 500,000 undergraduate and graduate students and professors and faculty and staff, we're in a state of flux, just like everybody else. And we are incurring expenses for that. And so what can the captive platform with our surplus and with our earnings, what can we do to give back to the university, which is our purpose, to help them support, give them some financial support to continue their operations successfully. So those are my hot topics. And I'm going to turn it over to Dan Caselia to find out what are your hot topics, Dan.
Thank you very much, and thanks for everybody for joining today. Hopefully everybody's at home. I'm guessing most people are at home, quarantined, having a good time, and really thought now would be a good time to listen to us. It just seemed like yesterday, right around the corner, we were dealing with tax reform. And lo and behold, out of nowhere, we get hit with, as somebody put it, one of the worst epidemics in a century. And Congress acted pretty swiftly and came out with the Coronavirus Aid, Relief, Economic Security Act on March 27th. And what it did was try to put cash in our pockets. So right now, I like to say cash is king. But one of the very first things that it did, as Chaz described, was it extended the due date. So all of our tax returns, our 1120 PCs, our insurance, our business tax returns in the insurance world, for the most part, were due April 15th. They extended that, now it's due July 15th. They also extended the payment. So if you had a payment due, you can extend that payment and defer it till July 15th. Same thing to do with first quarter estimated payments. So while you may have your extension in hand and so forth, you may want to hold on to that cash. You're under no obligation right now to submit that to the IRS until July 15th. So it's good cash-wise to know what your payment's going to be, but going forward, you should really have that conversation of when you submit the payment. Knowing that cash was king, what the IRS did was they brought back an old rule that happened right around 9/11, was instate a 5-year carryback rule. So now if you have losses coming through, operating losses for 2018, 19, or 20, you can carry those losses back 5 years to recoup cash that you paid to the IRS back then. That is an enormous benefit to a lot of folks, a lot of captives we're dealing with, and especially what may play out for this year. The old rule was 2 years, so giving us an added 3 years is extremely beneficial. They've also, and a lot of my clients fall in this, they paid AMT, alternative minimum tax, before they did away with it with tax reform. Now we're allowed to refund those entire AMT credits, and we could get those back immediately. Business expense interest, they limited that before to 30% of our income. Now that's capped at 50%. And for those large captives that have payroll, which some I do, a lot of group captives and so forth, there's some payment deferrals there, along with credit, some payroll credits. Looking ahead, what should we be concerned about? Well, given the fact that we may be hit, our captives may be hit with some business interruption or other types of payments, and some premium volume may be decreased by what's going on, we have to give consideration to valuation allowances. And this is going to be an audit thing. So what is a valuation allowance? A valuation allowance says, hey, look, that deferred tax asset that I have on my books, I might not be able to keep that. So I have to put this contra account and take an asset off my books, which is going to deplete my surplus. And if it's depleted enough, I have to put cash in to my captive to keep it writing the business that I had. Those are going to be conversations that you should have with your auditors and your clients immediately, rather than waiting till next year. So that's one thing. The other thing to be wary about is the portfolios, right? A lot of our investment portfolios are decreasing, unfortunately, over the past several weeks, and we're not quite sure when they're going to come back. So there is something with specific to insurance companies that if you have what's called an abnormal loss, which means you have to sell assets in order to either pay policyholder dividends or pay claims, you might be able to turn that capital loss into an ordinary expense, thereby increasing a net operating loss. So those are just some things to think about and consider. Congress did act fast. They are coming up. I do hear that there's going to be other stimulus packages and so forth. So as we go through this, there may be new things coming down the pipeline that we have to pay attention to. So tax is an ever evolving world, and things change by the week. And with that, I'll turn it back over to Dan Toll.
Yeah, and I'm just going to ask you a question from, there are lots of people on this call that I'm sure didn't follow all those intricacies. I guess my quick question to you is, tax changes, is it good for captives or bad for captives?
Yeah, so ironically, this is a good one. We finally got something from the IRS that's good, that puts cash into our pockets. Now, extending the due dates, that's extremely favorable. Extending the net operating loss carryback rules, that's favorable, but unfortunately, it's favorable if we find ourselves in a loss position, which is probably unfavorable. So that's a double-edged sword there. But for the most part, these are favorable to the taxpayers. And for once in a while, we have good news to report to you.
No, that's good to hear. Dave Provost, I'm going to ask you a question. And I'm going to encourage everyone here to please complete the polling so we can look at our next topics to cover. But following up on something Dan Kusela said, which cash is king, what is that meaning to captives that have longstanding, good balance sheets, what have you? Are companies looking to their captive to pull cash out, or what are they looking to do right now, Dave?
Sure. It's hard to tell on a longer term, bigger picture thing, but or point of view. So far, things seem to be pretty normal, but we have had, I think, maybe 3 instances so far where companies have written in for a plan change to say, our parent company needs cash. I think 2 out of those 3 were hospital systems, and they would like to take withdrawal from the captive. And in both those cases, they had buckets of excess capital in the captive. And we often get requests for loan backs or dividends with captives, and they're usually pretty straightforward. The captive is usually so strong that even though it appears like we're giving away a lot of money, I look at it from the point of view of, okay, after I give this money back to the parent company, or after I allow it to be given back to the parent company, what's the captive look like? And in the cases that I've seen so far, it's been a case where the captive was so overcapitalized, had built up such a large surplus that even after they gave away 3/4 of their assets, they were still something you would look at and say, that's a nice, healthy captive looking at it now. So we're seeing a few of those instances. I'm sure I'll see a few more, but for now, it's not a huge draw, but it is just something I look at as I look at with any other dividend or loan back. is it appropriate? Is the captive still strong without that money? I try not to look at the size of the actual withdrawal, because sometimes, like I said, the captive is so overcapitalized, the withdrawal is huge, but what's remaining in the captive is plenty strong to support the captive's program going forward. So we're being we're operating normally. We're looking at these from a does this make sense point of view, and obviously in some cases we may look at it as, we got to save the parent. The heck with the kids. The parent needs to survive. So if those are the circumstances that they're in, we may do something a little extraordinary. But in general, it's been fine. You can have this cash because there's clearly more than you need in the captive for the captive to operate properly.
Great, thank you, Dave. And Lauren, I'm going to ask one more question of Chaz here before we kick it back to you for the voted topics. So Chaz, we know that there are lots of good captives that are small captives that are formed for all the right reasons. What are you advising those clients that received this notice from the IRS?
Well, this is a good opportunity for those taxpayers to say to the IRS when they're audited that we've got lots of losses. We're doing the things right. I think fundamentally the IRS is using this as part, as I said, of its ideas that it will audit thousands of people. I think that there are certain people who are going to respond to this whose statutes have already run, and that's obviously not an issue. And then certain people will decide, well, let's not get on the highway. And they say, my captive's run its course, and they may amend their returns. And then there will be others who say, I'm doing it for the right reason, but they need to recognize that the IRS is going to continue its very exhaustive and exhausting audits. And they'll likely be set up for an audit.
Thank you, Chaz. Lauren, you want to kick off our next topic for discussion?
Yeah, so just a reminder to everyone that we are using the website slido.com. So if you want to submit any questions, if you go to slido.com and enter captive virtual, you can submit some questions on any of the topics we've spoken about or any hot topics in the captive world. So we're going to have a look now at the live poll. You can also vote on the live poll there. So it looks like the most popular topic right now we've got is captive opportunities from coronavirus. So I guess if we're going to hand over to the panel, I think probably our captive owner, Courtney, might have some interesting thoughts on this. I guess if there's any opportunities to be had for a captive because of coronavirus. Courtney?
Thanks, Lauren. I think that the opportunities for a captive, there's a few different areas in that I'm thinking about right now. Is I have an opportunity with surplus to finance certain risk mitigation, loss of income type of claims. So, for instance, we have a student study abroad program, and where we have tens of thousands of students that are studying abroad, and from a reciprocity standpoint, students from those countries come back to the UC system and they study abroad at our system. Well, as you can imagine, there's a lot of and we've got locations all over the world. And so what we did is we worked with them a couple of years ago to create a bespoke policy that will provide funds for them in the event something like this were to happen. And so when I look at opportunities, it's not necessarily an opportunity to create something new because we already have it, but it's an opportunity for the captive platform to perform. And it's like I told my boss and board of directors, is the reason in the last 4 or 5 years we've built this big captive platform with all these captives and all this diversification, and as they used to tell me, all the weird stuff you're doing with the captives. Well, this is a good time to validate and to recognize the fact that we've built a very, very strong foundation here, and we have opportunities to serve our parent. We also have opportunities to create new bespoke policies from the captive to ensure that the little things that we find out about this COVID-19, where there's gaps or where there's not enough, in many instances, and we're issuing and doing probably over 50 different risk financing arrangements for the university, and more than a handful of these are policies that we've crafted, we've manuscripted ourselves to address a specific need. So I can see, from an opportunity standpoint, I can see that when this all washes out a few months from now, and the financial impact, the total financial impact of this is felt 4 months from now, what we're going to do is we're going to sit back and as I can see it, and say, okay, where were we needed? Where will we be needed in the future? Because right now, as we all know, there's that a lot of this is not quote unquote covered by insurance, and so, but as a captive to my parent, I still have to pay, and I've structured all my policies so that I've got the ability to pay anything. But you can find these things that are going to these gaps in coverage that we're going to find coming out of this will span multiple policies and multiple major coverage lines. And so what we will be able to do in the future is learn from this and say, okay, we need a bespoke policy for this for our campuses. And we can create that, and then we can go out as an insurance company and collect appropriate premium for that. And now we've got our bank account for that and continue to do so. Because as we're finding out, and I'm kind of reiterating, is that technically speaking, the insurance industry has been excluding pandemic for years. And I got that, and we're okay there, but we're going to find out new stuff going that's going to spit out from this whole operation down the road. The captive will then be able to go out and attack that particular need, craft a policy for it, collect the appropriate premiums so that if and when this happens again, we're not having to dig into surplus to build this stuff. We're digging into actual premiums and claim reserves and IBNR that's been set aside specifically for this.
Thanks, Courtney.
Okay.
I got a question, kind of a follow-up that to you, Dave Provost, from a regulator's perspective. Are you seeing existing captives that have broad enough policies that pandemic and COVID may be included in their existing policies and there'll be claims against the captives, or are you seeing captives wanting to make plan changes to do that for the future? Because as we talked about before, certainly many of these companies are taking huge economic losses and are looking at ways to access cash that potentially is in their captive.
Right. You know, I can't really directly answer that since you've seen one captive, so I'd have to go through policy by policy to see what's actually in there, and I'm sure every captive we have is going through policy by policy to see what their actual policy says, to see if it excludes pandemics or anything like that. There's a reason insurance companies don't cover pandemics. It's you collect a little premium from a lot of people to pay a few people a large dollar claim. In a pandemic, everybody has a claim, so it just would collapse the insurance system, and that's why it's excluded. But that doesn't mean that you have to follow the market for your own captive. So that is a totally individual circumstance. I'm sure, I guarantee you, it's going to be looked at in any captive formation going forward. That how do we handle this? How do we account for it? How do we finance it if we're going to include it? And going forward, it's going to elevate the visibility of the risk manager to deal with these things that are threaten the basic threats to the business. It's going to be risk managers are going to be much more involved, or at least much more visible. And I think that you'll see new captives coming out of that, just because they're look, we got to account for who knows what now. This is going to change some of the basic views of accounting for future risk and prospective risk that risk managers and companies are going to have to focus on.
So I think that's all very interesting. I think some of what we've spoken about in terms of opportunities kind of leads into the second most voted for topic, which is kind of business interruption insurance. And I think a lot of organizations have realized the gaps in their insurance and how it's not covered by pandemics. So does anyone on the panel, maybe we haven't heard from Dan Casella in a while, have any thoughts on, the I guess what's going to happen when we come out of this, and if there is any opportunities for captives in this space, and how it's going to play out in the market?
Yeah, I tend to be optimistic. I might be the only one, but I look at this as an opportunity for the industry to shine. I'm sure a lot of folks saw the New York Times article that came out maybe a week or two ago, talking about how captives were built for this, and they were able to help with the coronavirus because their coverage is provided for insurance for this, where a lot of commercial policies don't. And from what you hear, there's a lot of talk where where a lot of the states and so forth are trying to force the insurance companies to go ahead and retroactively cover all the epidemic when their policies weren't written for that, weren't underwritten for it, didn't have the premium for it, and so forth. Meanwhile, captives are sitting here as the perfect solution. So I'm one that is optimistic, saying this is what a captive was made for. This is why we're here. This is our time to shine. And looking ahead, I think that the world is open for us to cover stuff and to prove our worth.
And this is Chaz.
Go ahead, Chaz.
Yeah, and from a narrow tax perspective on these small captive audits, it also will demonstrate to the IRS, who's been skeptical about low loss ratios, that when you have low frequency, high severity coverages, sometimes they pay off. And this is, as Dan Casella said, this is exactly why you had captives. Go ahead, Courtney.
Yeah, I was just going to say, and those that know me know I'm always full of sunshine and looking with everything half full. But one of the things that I see as a captive owner that's going to come out of this, that's going to be a benefit to me and other captive owners going forward, is data. We're going to get a lot of data out of this. And we're all in the insurance business, and we all know that insurance starts with data. And what we're going to be able to do with this data is we're going to be able to put a number on it. And if you reverse that back into price making, I think we're going to have a robust database where those of us that have the ability to, as captive owners, have the ability to write bespoke policies to our parents to cover things like this, we're going to have some data behind us in order to justify the premiums that we're going to be charging. It's going to help us with our relationships with the regulators as well, because if you go to the regulator with something you just made up, as David will tell you, that's really not a comfortable conversation. So I think that this is going to be a good outcome. We've also seen a lot of movement recently of adding pandemic to TRIA. And I think that's a good conversation, because while organizations of our size have the ability to collect premium for coverage such as pandemic and have possibly enough horsepower in the reinsurance marketplace to go out and get some additional cover, the small business owner doesn't necessarily, outside the 831B, the micro captive space, which I think is a fantastic solution for a small business owner. But I also think that if you this crisis has prompted this talk to add pandemic to TRIA, I think that's very good for Main Street business and small businesses that don't have a captive, but the industry can respond and in pushing the government to add this to TRIA so that we've got broader coverage.
And this is Dave, if I can chip in my 2 cents on this one. And I will, since nobody's telling me not to. So, just three comments. One, Courtney mentioned the glass half full, glass half empty. There is a third option there, and that you just need a different glass. So I want people to leave today with at least something they can remember forever. You have a glass half full, glass half empty, or you just got the wrong glass. But the TRIA conversation, I think, is going to be something that will happen pretty quickly, that including a pandemic backstop like we have for TRIA is going to provide an environment where business can know what the results are and have something in place to deal with this. And that's what the TRIP program did, was it gave you a path. So here's how we're going to deal with this, and everybody got involved, and that worked very well. Back to the business interruption, and back to my comment earlier about why pandemics are excluded, I agree that the captive is a solution for this. I do wonder, though, if the captive is in a pool with a bunch of other captives that have the same policy, like may have been put together by a promoter, if they're all going to have the same claim and therefore all reinsure each other and wind up with I don't want to call it a circular transaction again like the IRS does, but you may get reinsurance coverage of your claim, but at the same time, you're going to have to cover your reinsurance share of everybody else's claim in the pool. So the net gain would be zero for you, provided everybody paid in when they were supposed to, because that is one of the risks of the pools. Some of them are not funded. They are, when we have a claim, you'll pay in. They don't necessarily have the cash in the pool ready to pay a reinsurance claim when it comes due. So that's I think you're right that the captives are a great solution here, but there is some risk on making sure you understand how your captive is going to work in a pandemic environment.
Yeah, this is Chaz. That's a good point. But in a pool, you may have insureds from different industries. So the hotel industry obviously has taken a real hit, but there are others, the FedExes of the world and the Walmarts of the world, who have, and Amazon, who are thriving in this. So if they are in a pool, or those people in those various industries in a pool, it may really function exactly how it's supposed to.
Yeah, it's a really interesting discussion. I think that business interruption is going to be a really, again, a hot topic, which is why we're discussing it in coming months, because it's been a really big discussion point for a lot of companies currently. The last topic we have to discuss, which has been voted on, is new formations in a pandemic. And I guess we have touched upon this a little bit earlier, which is just, I guess, will there be, the same rate of captive formations? Will there be less formations, more formations, because of the current situation? Might start with Dave.
Sure, I'll prognosticate a little bit, even though I usually hate doing that. My guess is that you're going to see a slowdown this summer just because of uncertainty, but that after this is over and we've stabilized, you're going to see a lot of new formations, just as we did with TRIA, it may take a little longer for that slowdown to ramp back up. But my guess is that's what's going to happen. We are still forming captives right now. We've got a number of applications in process. We have several new business conversations scheduled for the next couple of weeks too. So things are still, for those companies that are operating, things are still moving forward, and that's pretty positive. And frankly, from the regulator's perspective, I've got one person on staff who wasn't capable of working at home. The rest of my staff, we got 32 people working at home, most of whom normally work at home. So we're processing things just fine. I've had emails with the Secretary of State's office today. They're processing things. So there's no reason, nothing's going to stop it from a government perspective. And I think most other states that I've talked to also are pretty capable of working remotely. So things are still progressing and moving forward. So that's a positive.
Thanks, Dave. This is Dan Toll. This is my topic du jour when I talk to people throughout the day. What is the market? How are things looking for you? And I've talked to many consultants that had one of their best first quarters ever, believe it or not. And a lot of activity is going on out there. I think there's a lot of people holed up at home that want to have something they can focus on. And clearly, there's a lot of unknowns that are brought by COVID and what the future looks like. And I think a lot of companies that haven't looked at forming captives are spending a lot of time and attention to that right now. So I think, and history has shown, after unfortunate events like 9/11, that the market was very good for the formation of captives. And again, I think this is an opportunity for our industry to come up with solutions that aren't readily available in the traditional market. And so, of course, we're all distracted, but I think the captive is something that people are still looking to focus on. So.
Dan and Lauren, this is Courtney. To take the new formations topic and just kind of blend it a little bit with the first topic, captive opportunities. As a captive owner, one of the other things that I look at is what new initiatives can I launch throughout my system that may require a new captive in our cell captive structure, or it may not. But what new initiatives can I launch where it generates an underwriting profit that can help support the balance sheet of the captives in the aggregate to help continue to grow the surplus for events like this in the future? So it may not necessarily be a new captive per se, but a new initiative, more utilization of your captive, which generates income to the captive, profit to the captive, where that profit can be socked away as surplus to help support crises like this in the future. And so, for example, take a look at your warranty program. You know what? Your computers, your phones, your copiers, and all that. Well, organizations may spend a lot of money on that, and half of it is profit to the warranty insurance company. Well, if I now take that into the captive, that profit stays with me, and that profit can be used to support things like this that happen in the future. So when I look at new formations, I also see new initiatives where I think your boards of your parent would be supportive of you to go out and continue to grow your surplus.
Okay, well, I think that's all very interesting, but unfortunately, I think we've run out of time a bit to talk anymore on these hot topics. So we are going to have to switch over to the Q&A portion of today. So we have got quite a few questions that have come in. So we're going to come over, and you can submit some more questions at slido.com if you have any. We have quite a few that have come in. There is some from many different people here. So we've got one here that has been submitted about if pandemic is too broad and high risk for captives to take from a risk appetite perspective because the severity is quite high. I mean, we've got, Courtney, as a captive owner, do you have any thoughts on this about putting pandemic coverage into a captive?
Yeah, I think what's important to understand is that you can put it in the captive as long as you have the money to pay the claims, and much like if you put it in the captive and you don't have any corresponding premium, then it's just a loser. But catastrophic loss in a captive is not necessarily a bad thing. I mean, we have $60 billion worth of property up and down the coast of California, and we have these things out here called earthquakes, and I have earthquake running through the captive. Cyber is normally a quote unquote catastrophic cover, and with our population, we've got a huge exposure to cyber, and we have that through the captive. And I think what we're going to see is there's going to be a pandemic reinsurance solution that comes out of this, because if the insurance and the reinsurance industry is anything, it's opportunistic and to a degree predatory. They're in it to make money. They know there's a big exposure here, and I think down the line there's going to be some form of catastrophic cover for pandemic that can sit over a large retention within a captive. So I don't think it's too risky. I think if you're like we are now, we're kind of going bare. If you don't have the surplus to pay it today, you're not going to be able to pay it. But I think from a long-term standpoint, I think you're going to find a solution in the reinsurance marketplace. Possibly, although it's rare to have a insurance-linked security ILS placement for casualty lines. But I just firmly believe there's going to be a solution somewhere for reinsurance or excess or cat bonds that captives are going to be able to access after they take their own retention.
Thanks. And we have a question here for you, Chaz, about if we're seeing anything from the IRS audits of captives that are owned by non-USA domiciled parents. Do you know much about that?
Well, right now the IRS appears to be focused mostly on the small captives, and those are ones that have elections that are taxed favorably or have additional tax benefits from, as opposed to the larger captives. And the IRS is agnostic, that they don't care who the owner is. If they don't like the program, they're going to go after it. So in general terms, there are fewer captives that make these elections that are small or are small enough to be qualified under 501c15 that are owned by non-U.S. owners, but that wouldn't stop the IRS from auditing them.
This is Dan Casila. I can tell you firsthand that I have several foreign-owned U.S. captives that have made the 831B election, and the IRS is not showing any distinguishment. They are proceeding as normal, and I'll echo what Chaz has said. If they don't like the program, they don't like the program. Doesn't care who owns it.
I agree with Dan because he just agreed with.
All right, thanks so much. And we have a question here for you, Dave, which I know that you've done there has been some changes here. So how is Vermont addressing the board meeting requirements during the current situation?
Right. We just sent out a message to all of our captive managers and other email contacts a couple weeks ago that we recognize that travel is going to be next to impossible this year. And so, although we didn't just do a blanket, don't have a meeting, we did let folks know that, just write in for an exemption for the Vermont meeting for 2020. Same with travel for preliminary meetings of forming captives. We always like to have a face-to-face meeting, but we realize that's not going to happen this year. And at the same time that we're just expressing a willingness to waive the board meeting requirement. That's only the in-person requirement. We still want the board to meet, and the company needs to have proper corporate governance. So either have your board meeting telephonically or virtually, I think is what we actually said, but have an electronic board meeting or in person at your own offices if you're not doing or once social distancing is passed. But we just, in practical terms, nobody's gonna be traveling for quite a while. So we've all but eliminated the requirement. We just want to have it documented as a request for an exemption, and we're granting those without any question.
And I've got another question here that Dave or some others might have some interesting thoughts on about if there's any increase in captives considering runoff. And if you have any thoughts on, I guess if we're not seeing it now, but anything in the market that might see that because of the current situation.
This is Dave. I haven't seen any particular increases in runoff captives. There's always a few captives that are finishing their life cycle rather, and going into runoff. I would actually say that the hard market is helping some of those captives come back to life and revive their interest in having a captive. It's helping to remind some of the members of group captives in particular that, hey, there was a reason we formed this captive back in the 80s, and now we're seeing that there's a great value to having this to help us control the environment that we're in. So there might be some captives entering runoff because of the current circumstances, but I think there'll be just as many that are that get revitalized because of this and add new lines of business and even add new members as things get tough for the economy.
And there's actually a question here that I know that Dan Toll might have some thoughts on, and I know that he has been following this very closely about what's going on in Washington State with everything that's going on with the current situation there. I know there's been some, if anyone's been following the legal situation with the insurance commissioner there.
Sure, happy to answer that. And I'm not sure this has widely been published yet, but there's a bit of a ceasefire that's happened between the OIC and the industry. Legislation had been introduced this year to try to come up with a solution that was largely going to affect some of the large captives that were located, headquartered in Washington State. The legislature, however, never came to a conclusion on that, but they have an agreement between the legislature and the commissioner basically to cease their action for the next year, while I believe the OIC, the Office of the Insurance Commissioner, is going to spend a little bit more time studying captives. I also think that that's going to give the legislature a little bit of time if they want to come up with perhaps more thoughtful captive legislation. But in the short time, it's a timeout for the next year, but it's hard to say at this point what direction we'll go after that. Dan Kusela, do you have any other knowledge or thoughts on that you might like to add?
No, I just think we're going to wait and see moment. I know I have one client that we self-reported for that we got a notice back saying that they're in a wait and see moment. So I think we're in a wait and see moment, but I think it'll be curious to see where it goes. Yeah, and then
Yeah,
not
right.
only state though, you've got other states that are trying to push through legislation as well. So while we're all focused on Washington now, I think we've got to look around the U.S. and especially going forward, with people that are going, states that are going to be strapped for cash. The other states might try to latch on and come up and see a revenue raiser in the captive industry. So we've just got to stay tuned and see what happens.
All right, we've got another question about, someone has asked, I know it was in our poll, but it didn't make the top 3, if we can touch on the new coverages about working from home. And I guess now there's some new coverages that could be taken on now that we've got vast people working from home, when previously that wasn't the case. And, you know, I guess we could maybe start with one of our, you know, maybe Courtney as a captive owner. Have you got any thoughts on coverages about, you know, with working from home and how that might change?
Well, I think that's a great question, and you know, I'm trying to think about what would they be, and I think it's going to vary by circumstances. Of course, you've got workers' compensation. All right, somebody gets hurt working from home, then you're gonna pay the claim. I think you've got, you know, you've got the same exposures from a GL standpoint. I think your cyber exposure is going to go up, because I don't think people are as buttoned down at home from a cyber standpoint as they are when they're at work. But I think I'm just as curious as everybody else to find out what is the rollout of this for coverages that maybe your captive doesn't have. And I'm just, you know, I'll throw it back to everybody else. Can anybody? I don't know right now. I don't know what new coverages would emanate from working from home that wouldn't necessarily be covered under the traditional contracts that the captive is reinsuring today.
This is Dan Casilo. I think we're all about to find out, right?
Yeah, well, you're right. Yeah. Yeah.
And this is Dave, reading from the Captive 101 book. It's, you can manuscript your coverage, so you can have captive owners designing programs to account for it and you know, finance the risk of having people work at home.
Yeah, and this is Chaz. Even though everybody's working at home, there may be business invitees who wind up not coming to the central office, but coming to individual residences for a short meeting or something, and that might generate, as Courtney said, some liability, general liability, some like trips and falls at the residence. So that's a different location as opposed to a different coverage. But now if you've got 100 people that are having guests come to their home, it's 100 locations instead of one location.
All right. Well, unfortunately, I think that's all we've got time for in terms of Q&A. But you know, I think it's been really great. So I'll hand back to you, Dan. I think you wanted to say a couple of words.
Yeah, first of all, just want to say thank you all for listening to our webinar, and we want you to all be safe and healthy, and certainly also want to thank our panelists for the great job they did, and certainly be on the lookout for both Captive Review's upcoming sessions, and also with SECA, we'll be putting out a webinar series here in the near future, and look out for those. We all certainly know how important it is for our continuing education, since we're not able to travel to conferences and hear all these sessions live. So with that, I hope you have a great day, and back to you, Lauren.
Yeah, so thank you so much all for tuning in. So just a reminder that next Tuesday we have our next virtual symposium on the global hardening market. So I hope you can all tune in for that, and thank you so much.